how do we assess the viability or otherwise uh, of the startup? And then we'll come back to the practical perspective when the startups submit their proposals, financial proposals to the bank or to the financial institutions, how those are assessed, and what are the latest changes in terms of income tax and GST for startups. So let us understand the fundamentals or basics of the startup assessment or viability. Definitely, it starts from the financial perspective of a startup. So there are different ways in which the startup grows. So probably the first one comes up with the new idea in the minds of an entrepreneur or the owner of a startup. Now that is typically called as a value proposition. So in this case, the entrepreneur wants to solve some real-time problem, real-world problem of a particular segment or the business or the industry. So it requires a lot of study from the entrepreneur's perspective. It is called the first step in terms of idea generation, which also is close to the concept called as value proposition. So in this case, what are the core values of the entrepreneur which he wants to address for a particular customer segment or for a particular industry? So this value proposition will aim at giving a solution to the current business problem of the industry. The entrepreneur can think of, can the solution be provided in the best possible manner or in a different way, which will reduce the cost of the product or service, which will improve the quality of a product or service. Sometimes the entrepreneur can also think the same product, can it be made available to different customer segments with different pricing strategies and so on. So what is the value proposition of an entrepreneur in terms of the business solution? This is the first step, and I think entrepreneur in this case is really have to work hard to understand what kind of benefits he is going to pass on to the customer. Second perspective is a market feasibility study. So there are different feasibility studies which will confirm the viability of the business. So the market feasibility study is also an important part. In this case, there are two ways in which the entrepreneur can carry out this study. One way is to do it himself or herself. When the entrepreneur goes to particular industry or particular area, he can find out what are the typical problems faced by the industry and he can arrive at a solution. He can also judge what will be the demand for the product, what would be the price point, what would be the pricing strategies, the time span in which this product should be sold or made available to the market. That is one way where his own study or input from his colleagues, some experts will be quite useful. The second way is to outsource this entire activity to an outsider. Typically, a few consulting firm, market research firms carry out this exercise on behalf of the startup or the entrepreneur. So it's an outsourcing activity. So you give this task to an outside agency who is expert in this, and they will submit you the report. This market feasibility study will definitely give you an insight of your product, service, or some new activities which you want to launch in the market. If the report of market feasibility study, your ideas or your new thoughts or innovations are positive, then you can go to the next step. In the third step, probably what is more important is a risk assessment by the entrepreneur. There are different types of risk which may impact the business. So probably it could be a market risk, it could be a financial risk, it could be operational risk, there could be a technological risk. So entrepreneur will have to study all these risks in detail. And if all the risks are either mitigated or it could be solved in the due course of time, then probably you can go to the next step. So these are the typical steps which the entrepreneur would like to take. Next part of the risk assessment is then identifying your customers. So who are your customers? Customer segmentation is also important. So when you are delivering the value proposition, who are your target customer segment? Because that will bring you the revenue streams. Normally, an entrepreneur will have a specific one stream of revenue, but in some cases, there could be multiple streams of revenue for the entrepreneurs. So customer segmentation and revenue streams can also be worked out or can be found out in this stage. Normally, when the entrepreneur is getting a continuous feedback from their customers, maybe from different ways, then it helps them to improve their product, improve their services, or bring in some kind of innovation in their processes so that you can retain the customer. This is very important. The reason being, next stage here is to maintain a good customer relationship. The customer should remain loyal to the business. They should bring in the continuous revenue to the business. And I think that gives up a robust model, a revenue model for the entrepreneurs. So after value proposition, risk assessment, customer segmentation, identifying the different revenue streams, and then the customer relationship, the next step is for the entrepreneur is to really work out on who are your key partners. There could be key suppliers to your business, how you can retain them, pricing negotiation with them, how they will help you in maintaining your key activities smooth throughout your process could be these major issues which I think the entrepreneur can solve. So identification of key customers, same way key partners, key resources, and key activities is also an important part for the entrepreneurs. As we move ahead with the assessment of the viability of the business, definitely the entrepreneur will have to find out their cost structure and financial modeling. The cost structure is very important in the sense the entrepreneur here will have to find out what are their fixed cost and variable cost. Apart from that, he has to also identify capex and opex. In the sense, these are different terms which are used in finance. So let us go one by one. In the first stage, as you are aware, the basic objective for any entrepreneur is to maximize the profit and the wealth. These are the two terms which are very important. In terms of profit maximization, it is a simple part. It's a revenue minus expense for the entrepreneur. So year on year, how can he maximize the profit? And in terms of wealth, if the entity is listed in the stock market, it is a market value of the shares. Otherwise, it is nothing but your share capital, reserves and surplus, or your own funds. Do you see the growth in that? So profit maximization and wealth maximization are primarily the objectives of any entrepreneur in the business. Considering that these two objectives, there are three types of decisions in the finance. So the first decision here is the investment decision. So the entrepreneur will have to find out how much they want to invest in a business, considering the market feasibility study, their plant layout, product and services, capacity, scalability, and everything. So how much investment they want to make in different type of assets. It could be land, building, machinery, computers, laptop. Sometimes it's an IPR, which entrepreneur want to build up or want to introduce. So there is the investment amount which the entrepreneur will work out. It is typically called as a capex. It's a capital expenditure by the entrepreneur in the business. Now, once the investment capex decision is taken, the next decision is the OPEX. So how much amount they should keep aside for their day-to-day operations or day-to-day business to run it very successfully. After this capex and OPEX decision making, the next decision is financing decision. So for the given amount of capital expenditure, suppose the entrepreneur wants to invest 10 crore rupees in the business, then how he will raise the funds from the from its own resources or from the open market. So that is called as a financing decision. So after the investment decision, financing decision, third decision is operating decisions or dividend decision. These are applicable only after the profit is earned by the entrepreneur. So it is slightly at a later stage. Since the objective is to maximize the profit, the entrepreneur will have to take these decisions of capex and opex in such a way that it considers certain elements of the financial decision making. For example, when the fund should be raised, it all depends on your capital expenditure. So suppose the capital expenditure is going to take in another 1 or 2 years, then there is no point in raising the entire funding at immediate point of time, because if you raise the funds and those funds are remain idle, it will carry the cost and it will reduce the profit and profitability of the business. So what is the timing of your funding is also important. What is the cost of funding? Because typically there are three ways in the funds are raised. One is equity funding, where the entrepreneur will bring in his own money in the business. Second way is to raise the money from the open market. It is in the form of debt. And sometimes there are different ways in funds are raised. It could be in the form of subsidy, it could be in the form of grants and so on. But primarily, owners funds and outside funds, that is a debt fund, is the major source of funding for any business. The cost of this funding will definitely change. So for a businessman, if they want to improve the profitability, they will have to consider the cost of funding also. Technically, lesser the cost is the best option for the entrepreneur. So here he will have to optimize the cost of funding so that the cost comes down and its profit is increased. When we are talking about this financial perspective of any business, the entrepreneurs will have to prepare the financial planning or financial modeling. So here they will make the projections of their 5 years or 6 years of profit statement, balance sheet, and cash flow statement. So these statements will help them to understand how their revenue will increase over a period of time, what will be their operating expenditure over a period of 5 years, how much will be the profit or profitability in next 4 to 5 years. Similarly, they will also prepare projected balance sheet and projected cash flow statement. Basically, these three statements will help entrepreneur to understand their financial model. Here, financial model is different than the revenue model. So in the revenue model, you understand the revenue streams, different revenue streams in which you get the revenue from your customers. Financial modeling is more in detail. It requires all the financial details. Sometimes it starts from preparation of a budget of an entity for 1 year or for a quarter, for 6 months, for a year, or and so on. And then you slowly build up the projected income statement, balance sheet, and so on. So definitely the financial modeling is more important from the entrepreneur's perspective. And here, the main job of a startup or a businessman or entrepreneur is to see where they stand uh, after each quarter or 6 months as compared to what they had planned earlier. So it's a comparison of actual versus budget. If the actual profits are more than the budgeted one, I think you are doing extremely well. So your business is viable. If the actual profits are less than the budgeted profits, then the entrepreneur will have to revisit their business model and will have to make a lot of changes in terms of their financial plans. So these are the fundamental perspective of assessment of the viability of a small startup or a businessman. Here, I think we have one expert, chartered accountant, Kiran Kunte. He will also explain you how the banks or financial institutions look at your projections, the documents which you submit to the bank. So how do they look at it and how do they assess the viability of the project from the financial institutions perspective? So let me introduce chartered accountant Kiran Kunte.
All right. Very good morning to all of the participants. And I'm just carrying forward the point stressed by Dr. Chirputkar sir, and with specific reference to this assessment of startup viability and funding options and GST. See, he has already made mention of various costing structures, capex, opex, as well as financing decision. Let me explain this same concept in a typical language which the bankers are using. Bankers are using a particular report which is called as a CMA report. It's called as a credit monitoring arrangement report, which is generally prepared for a projected financial statements spanning over a period of 5 years. The position, the expected and projected estimated financial position of 5 years, it gives a reasonable feel to the bankers about the safety and security as far as the repayment of their loan is concerned. Now, as far as the CMA report is concerned, I am not going into the much details of the profit and loss account and balance sheet. But one thing is that, see, many times it is very easy to prepare on Excel or PowerPoint presentation, easy to create a rosy picture. But as far as the financer is concerned, he will not get that simply impressed with the presentation or PowerPoint based on your own estimates. They have their own mechanism to assess your numbers, etc., etc. Many times for a larger project, they will also ask for something called as a techno-economic commercial viability. There are many organizations like, say, for example, in Maharashtra, it is MITCON, MITCON. You can browse through their website. It is in the public domain. So there are many such agencies which would be doing the techno-economic commercial viability of such new startup. Now, there is a slight difference between feasibility and viability. See, what may be feasible need not be necessarily financially viable. And what is financially viable need not necessarily be feasible. We have to achieve both objectives simultaneously, that it should be feasible as well as it should be visible. It should be viable. And this is possible only when we have a business model which is a scalable business model with high potential of a wealth creation. The model has to be scalable and sustainable. Let me clarify what I mean by scalable. This concept is also mentioned under section 880 IAC of Income Tax Act. I repeat the section number. You can use the web resources to know the details of this particular section. Since this is a legal section, I'm not going into further details, but I would urge you to browse through this section, provisions of this section, which specifically deal with various benefits available to an eligible startup unit. The recognition of an eligible startup unit is given by DIPP, means Department of Industrial Promotion and Policies. So when you are preparing a skeleton for your projected startup unit, ensure that you are in a position to satisfy this DIPP, that is Department of Industrial Promotion and Policy, with a concept that you are in a position to produce a scalable business model with high potential of wealth creation. When I say scalable, means in the initial years, you being a startup, not necessary that in the very first year you will start generating profits. But as and when you mature further in the business, that is over subsequent periods, second year, third year onwards, when the business crosses the break-even level, then the revenue should start mounting in a faster way. That is what we mean by a scalable business model. And for that purpose, you have to prepare your own assessment of techno-economic commercial viability. See, the summary is that the financiers, let it be equity holders or debenture holders or bank or even private equity players or even venture capitalist fund, they will not simply get impressed by a rosy picture created by you. It should not happen that you have something, only a fanatic idea in your mind. Whatever is your idea, it should have a commercial value. And when I say commercial value, means the idea should be in a position to generate revenue, maybe initially at a lower rate, lower speed, but finally, after second or third year, when you consolidate, when you start growing, this revenue model should start a scalable growth in this model. Now, what happens is that since typically we are focusing our discussion on startup phase, we know that it is based on so many assumptions. Now, all those assumptions may not get materialized in the very first year. But as far as your financer is concerned, I repeat, whether it is a debenture holder, bond holder, or persons contributing in the form of public deposits or bank borrowing, whoever is willing to finance you, he will have to assess your debt repayment capacity based on different scenarios. This concept is called as scenario writing, even in finance as well as in management. In case of banking assessment, this is called as a stress assessment. For example, if the estimated revenue doesn't get materialized, or if the estimated revenue is achieved only to the extent of 80%, what would be the situation? If the estimated revenue is achieved in reality only to the extent of 70%, what would be the situation? Of course, that situation may not be that favorable, but bank will try to find out after putting your financial information to a stress level, and they will have to ensure, and you will have to prove that my estimated revenue will not fall below a certain level of achievement as compared to my estimation. A financier would get comfortable only when you are in a position to submit this feasibility and viability report based on various assumptions, estimations, which have been tested on various circumstances. For example, decision making under most favorable condition as well as decision making under most unfavorable conditions. As a startup entrepreneur, your idea of most favorable condition as well as most unfavorable condition, it should be very clear in your mind. See, in case of finance, I have been always saying that head is above heart. The financial world operates more with brain, not by heart. So when you are about to enter into a new setup, new business line, your concept should be absolutely clear. And once your concepts are very clear, let me tell you one thing. You might have heard a concept called as a unicorn. There have been several startup units which started with a humble base, but which were having a sound, scalable revenue model, which finally proved that they have materialized their assumptions and which could finally establish that the commercial idea which they were nurturing in their mind has a commercial value and it has generated into revenue. In a span of 5 to 6 years, those startups have become unicorn, means their valuations have crossed $1 billion. As recently Sir said that finally you have to maximize your profitability and wealth, etc., etc. Let me go one step beyond. See, the ultimate objective of any startup over a substantial period of time, say 7 years, 8 years, it should be maximization of your business valuation. Because if this valuation goes up, then it might be possible for you even to take an exit from the startup with a huge premium in your pocket and then reinvest the proceeds in another business units. So this was about the various kind of business models which a startup unit should consider. You should have an ideal mix of equity finance, debt finance. It's called as own finance and borrowed finance. There is nothing wrong in borrowing money because the moment you borrow some money, you remain answerable to other stakeholders also, so that it creates a commitment on your part that I have to do my business absolutely responsibly well, because irrespective of the financial outcome, I have to satisfy the claims of my financial creditors, I have to pay interest, I have to service their loan obligation. So debt is a good part. So long as your return on investment exceeds your cost of funds, you should better borrow. To be very frank, this is called as a leveraging out the financial structure. In the long run, your objective should be leveraging your financial strategies, and finally, you have to maximize the valuation of your business. That is the outcome of total financial modeling.
Just. Just.
Okay, okay. I also want to talk something about the GST, the law which is pan-India. Now, everybody is aware that typically this law has been fulfilling the principles of one nation, one tax. There is a threshold limit for making a registration under GST Act. As far as services are concerned, if the annual turnover of your services exceeds 20 lakhs, you have to get registered with the GST authorities. If the turnover of the business of production and sale of goods, etc., if it exceeds rupees 40 lakhs, 40 lakhs, the registration is mandatory. But in one situation, the registration is mandatory irrespective of the turnover threshold limit. That if you are rendering your services outside your home state, which is called as the interstate services, in that case, GST registration is mandatory. And also when you are doing your business with the use of a digital platform, like, just for example, I'm saying, I'm not marketing them, let me clarify, just for giving you academic clarity. Say, for example, Amazon. If I am selling my product or if I'm marketing my service based on such or digital platform, then in that case, the registration of GST is mandatory right from rupee 1 of my initial turnover. As far as GST is concerned, the registration process is absolutely easy. No paperwork is involved. And to be very frank, once the entire process is so digitized, everything gets settled on one click of the computer button. As far as GST is concerned, GST number is concerned, it starts with the state code where you are situated. For example, if you are in the state of Maharashtra, your GST number will start with the state code of 27. It would be followed by your PAN number, and there would be another 3 characters. With respect to the GST, let me clarify a few more concepts. One is called as the HSN. See, the world has become a global village now, and all over the world, the goods are known by a specific number now. That is what we mean by digitization. HSN stands for Harmonized Standardized Nomenclature. And as far as services are concerned, they are known by SAC, that is Service Activity Code. Your every tax invoice will have a reference of your GST number, place of supply, the HSN of the goods which have been supplied, SAC of the service which has been rendered. It will also be followed by a document called as the e-way bill, which is normally handed over to the transporter of the goods. Accordingly, when you submit your invoice, which is called as a tax invoice to your end customer, you have to submit this information in the form of a monthly return, which is called as a GSTR1 on the government portal. By the way, as far as those customers are concerned, there are 2 types. One should be aware with this terminology. One is called as a B2B. B2B means business to business. And another is called as a B2C, means business to end client. Naturally, one particular question always crops up in the mind of especially a person who is registering his startup. Whether because of this, my goods or services would be ultimately costlier to my client. Would it affect my business? Would it affect my profitability? The plain reading might suggest something else, but let me tell you the truth. Nowadays, everybody would like to get himself or herself registered under GST. See, turnover limit of 20 lakhs is very absolutely meager and minuscule. What kind of startup entities we are contemplating, they are bound to cross the turnover limit of 20 lakhs very shortly. So registration of GST, it is in your benefit, because the moment you register yourself under GST Act, the taxes which you are already paying on your inputs, which is called as the input tax, are allowed to be set off against the taxes which you would be collecting on your output. So to be very frank, this GST law, it has avoided all what we call as the multiple taxation or cascading effect, which was there in earlier laws. This concept is called as the ITC, that is input tax credit. In simple language, it is called as the taking set off. So the summary is that because of the introduction of GST and because you come into the GST bracket, because you come into the GST network, your costing will not get increased, nor your sale price will get increased. Whoever is the person who is a registered dealer in the chain, he can claim benefit of the taxes which he have already paid on the inputs, and he can adjust this input taxes against the liability of his output. So rest assured about increasing the costing, etc., etc. It is not going to add to your costing burden, nor it is going to reduce your profit margin. What I want to emphasize is that make take maximum benefit of the GST provisions. The compliance is very simple. There is a digital portal available, and you can also complete. You see, if you are dealing with somebody else, just ask his GST registration certificate. As far as you are concerned, it serves your commitment of KYC, know your customer, because all GST numbers are based on PAN. So as a legally compliant person, if you are complying with the GST laws on this GST portal, which itself is entirely digital, you become a part of a nation building process, because GST in true sense, it is a law which ensures transparency. It enables you do the business throughout India without without a need to comply with the respective tax laws of each and every state government, because GST is a one nation, one tax act. I would urge you to be a part of nation building process by being a part of this GST network. Thank you.
Yeah. So that's the input from Chartered Accountant Kiran Kunte in terms of how the financial institutions look at the proposals of the startup, the Income Tax Act, which is applicable to startup, and then about the GST part. Now, there's a one question: is it possible to sell online without GST? If yes, are there any issues? So, there's a question for on GST part.
Okay. Is it, I simply read out the question mentioned by Mituya Pal in the chat box. Is it possible to sell online without GST? If yes, are there any consequences? As I have mentioned just now, if you are doing a business, I repeat, if you are doing a business and selling the products on an online digital portal like Amazon, this statement has started with if you are doing that business. In that case, the GST registration is mandatory. My answer started with line if you are doing a business. But if you are not doing this as a regular business, and if it is one of situation that if you are selling your old furniture, sofa cum bed on OLX, then there is no question of GST. But if you are doing a business, yes, GST registration is mandatory.
Thank you, sir. Any other questions if you have? So, yeah, another question is, do service providers need e-way bill equivalent?
Very good question. Because as I mentioned, before the digitization and before the introduction of GST, there were different legislations like excise duty or VAT or sales tax, etc., etc. There was a concept of waybill. It was a paper waybill which was being handed over to the transporter. In case of service, there is no question of transfer of service from one place to another. Especially nowadays, in case of 99% of the services are covered electronically, there is no relevance of e-way bill. So my take on your question is that there is no concept of e-way bill as far as service provision is concerned, and there is no such equivalent document also. Thank you.
Yeah, so this next question, e-way bill from or ship from, bill to, ship to, could you please amplify this?
E-way bill. It's a bill from supplier of the goods and it is addressed to the buyer of the goods. But many times what happens is that the goods are not supposed to be delivered at the buyer's address, but many times they are delivered at the address mentioned by buyer, which is called as the shipping address. So in substance, e-way bill will have reference of place from where it is supplied, and another is shipping address. Bill to is only for reference, but especially when the shipping address is different than the billing address, the reference of that would be made. Especially for merchant traders, yes, shipping address is mentioned.
Thank you all participants for your questions and the inputs. Yeah, it's the last question. Do we need to mention 6-digit HSN?
On tax invoice.
Yeah, on tax invoice. Yeah, on tax invoice, it's necessary. Okay, thank you everyone. Thanks a lot. Yes, ma'am.
Yeah. Thank you so much, sir. So
you.
participants, more than this, if you have any queries, so you can reach us to us. We have already shared you the feedback, like question form. You can fill that form. You can send your queries. We can handle these queries in the next session. We'll be having next session in the last week of March. That will be on IPR. And the last session will be of all together for whole our course. So that will be held in the month of April first week. So you can ask your queries in that sessions also. So thank you so much for participating and thank you, sir, for the session. Thank you so much. Krishna, you can just stop recording.